what's your general perception of Bitcoin? And it sounds like you still hold it in your portfolio. So you've got some belief there.
So I'm structurally bullish on Bitcoin as a part of our portfolio. I think it has a good 5+ year runway ahead of it in terms of increased adoption. The reason I like it is because it's really, when you look at it, it's one of the only truly decentralized cryptocurrencies, meaning that there's no central entity that can make more Bitcoins or change how the code functions. It's highly distributed. It even makes multiple sacrifices in terms of other capabilities in order to remain basically as hard and as immutable and as decentralized as possible. And in the wake of that, you had thousands of other, projects come along. Most of them are not as decentralized as they claim to be. I've written a number of times. I've been pretty critical on Ethereum. I've been pretty critical on some of these other projects. And I think that, not every single project out there is bad, but I think that there's it's kind of like unregulated penny stocks, basically, except that some of them are worth tens of billions of dollars or more. And so I think that for the most part, I am not bullish on crypto. But I've been bullish on Bitcoin, and I've been bullish on stablecoins as a technology, and specifically the fiat collateralized ones, not the algorithmic ones. And so, for example, that whole Terra Luna fiasco is one of the things I wrote about ahead of time and warned people about, because that, again, was in the bucket of just unsustainable things, malinvestments out there. And so I think that Bitcoin, as basically peer-to-peer encryption money, is a useful tool that people have now. And I think the market's going through the process of testing it, monetizing it. We're 13 years into that. It still has risks ahead of it. But I think if it gets past those risks, I think it'll continue to be a good investment. So I'm pretty bullish on that. But it's not something that, I think you want to have more exposure than your volatility tolerance or your level of research into that space.
Okay, great. I'm glad you mentioned the stable coins, because I had a ton of questions around that. It sounds like they haven't really sort of shaken your fundamental case for stable coins, because you're less into the algorithmic ones, which are the ones that have gotten in trouble for the most so far, right?
Yeah, I think so. Basically, what fiat collateralized stablecoins do is they make the peer-to-peer side tradable, while the custodian's still centralized. And there's two main use cases for them. One is that on these offshore crypto exchanges, people use them as a unit of account for trading. But I think the more interesting use case is that in emerging markets and frontier markets and other countries that are having currency problems, if you try to hold dollars, in a Lebanese bank or an Argentine bank, they can easily be confiscated from you. They can be converted to the local currency and then taken from you. And of course, it's risky to just hold dollars under your mattress.
Right.
And it's also hard to get. And so stable coins are interesting because, people in developing countries have a way to get dollar exposure in a way where, even though it's centralized, because the custodian is centralized, the custodian is outside of that country's jurisdiction. And so if you're an Argentine investor, having some stable coins can be a useful part of a portfolio. And it's a way to deal with, currency problems. That's obviously less volatile than Bitcoin. Now, there are risks around the collateral, and there's two main ones. There's Tether, and there's also USDC. USDC's 100% cash and T-bills. Tether uses a portfolio model, and so investors can choose which one they want to have exposure to. And so it's one of those things where I think that technology has legs to it, but of course there is regulatory risk. I think over time they're going to be pressured to be more and more in that entirely T-bill model, entirely cash model, and I also think it's large countries could go after them and make them basically be operated like banks. And so I think we're going to see regulations tighten around them, but that it's pretty obvious why people in developing countries tend to use them. And I think the trap that people fall into is to realize that just because something claims to be a stable coin does not make it a stable coin.
Right.
And so algorithmic stable coins have had a long history of failure. And the problem with this whole Terra Luna one is that they were giving people artificial high yields, 20% yields that were funded by VCs. They were clearly artificial to draw people in. And then it blows up. They're like, well, it was an experiment. It's just experimental technology. Well, you were drawing people in to an experiment with 20% artificial yields. So that's more than just an experiment. And so basically what they were trying to do was operate like an emerging market central bank, but without capital controls and without the ability to tax a real economy. And so algorithmic stablecoins are kind of inherently a volatile and dangerous area.